Hello and welcome back to the channel. I am Abhishek and I am thrilled to have you join me for another lecture on CFA Level 1 2025. Today's topic is Portfolio Management and Overview. I will cover all the key concepts so that you can feel confident and prepared for your exam. If you find this video useful, please hit the like button and subscribe to the channel. And as always, if you have any questions, please drop them in the comment section below. Now let's jump right in. So there are 6 learning outcome statements in this module. We'll go through them one by one. Describe the portfolio approach to investing. Suppose you have some money to invest. So should you invest in individual securities, evaluate each in isolation, or should you take a portfolio approach? By portfolio approach, we mean evaluating individual securities related to their contribution to the investment characteristics of the whole portfolio. So that is your portfolio approach. Now, why to use a portfolio approach? Portfolio diversification helps investors avoid disastrous investment outcomes. Let's say you have 1 lakh rupees and you invest those 1 lakh into a single security, right? You invested into, let's say, let's take a recent example. You had invested that 1 lakh into IndusInd Bank. Now, because of a single negative news about the stock, your value should have depreciated by 30% at least. So the diversification helps in this case. Now, instead of investing all of your assets into one single security, that means instead of investing 100% of the amount into a single stock, if you had invested 10% into that stock, the overall downfall in your portfolio because of that single news should have been limited to 3%. So that's how portfolio diversification helps. Investors can spread away some of the risk by taking a diversified portfolio approach. Rational investors are concerned about the risk return trade-off of their investments. The portfolio approach provides investors with a way to reduce the risk associated with their wealth without necessarily decreasing their expected rate of return. If you're taking a portfolio approach, it doesn't mean that your expected return will fall. Just that your expected risk, the risk that you bear for investing the assets, is lower than if you invest the assets into a single security. Modern portfolio theory. The main conclusion of modern portfolio theory is that investors should not only hold portfolios but should also focus on how individual securities in the portfolio are related to each other. That means we should be concerned that how the securities are related to each other, how they coexist in the portfolio. Diversification ratio. It's the ratio of the standard deviation of the equally weighted portfolio to the standard deviation of a randomly selected security. So that's your diversification ratio for a portfolio. Describe the steps in the portfolio management process. So there are three stages to portfolio management. The first one is the planning, then execution, then feedback. In the planning phase, you understand the client's needs. What are his objectives? What's his time horizon? And what kind of limitations does the client has? How much risk can the client absorb? So you get to know the client. Then you prepare an investment policy statement. This document is very much important. This document outlines all the client's objectives, his limitations, his time horizon in a documented form. IPS serves as a guide for you while you are into the portfolio construction step. Then comes the execution phase. In execution, first of all, you decide on the asset allocation, that how much assets should be allocated to each asset class and then to individual securities. You also decide that if you want to include the alternative assets such as real estate, hedge funds or not. Then comes the security analysis. Once you have decided that these many assets should be allocated to equities, these many assets should be allocated to fixed income, these many assets should be allocated to alternatives, then you decide that which security will you invest your assets in. Let's say you decide that you should have a 40% exposure to equity. Now, out of that 40%, how much should you invest in a single security and which securities should you invest in? That comes under security analysis. Once you have decided all these, then you move on to the portfolio construction step. The key objective is to achieve the benefits of diversification. The decisions need to be taken on asset class weightings, sector weightings within an asset class, and the selection and weighting of individual securities or assets. That's your portfolio construction. Once you have constructed the portfolio, then you move to the feedback phase. In feedback, you monitor the portfolio and rebalance it regularly. By regularly, the rebalancing is generally done on a fixed period of time, that is either quarterly, monthly, semi-annually or annually. The feedback also includes the portfolio performance measurement and reporting the performance. Describe the types of investors and their distinctive characteristics and needs of each. Describe defined contribution and defined benefit pension plans. First of all, let's consider the individual investors. Now, who are the individual investors? Individual investors are a general public who is investing into the market. First of all, they have short-term goals. Individuals generally have short-term goals limited to 5 years or 10 years of time horizon. Let's say the goals could include providing for children's education, savings for a major purchase like a vehicle or a house, or starting a business. The retirement goal, that is investing to provide an income in retirement. It's a major part of the investment planning for most individuals. Some individuals will be investing for growth and therefore will seek assets that have the potential for capital gains. Other individuals may need to draw an income from their assets. So therefore they may choose to invest more in fixed income and dividend paying equities. The investment needs of individuals will depend in part on their overall financial circumstances, such as their employment prospects and whether or not they own their own residence. The goals of the goals for individual investors will vary from person to person. They may also need to consider issues such as building up a cash reserve or the purchase of appropriate insurance policies. Then comes the institutional investors. Now, we have a defined benefit pension plans. Defined benefit pension plans are those who have a fixed obligation to pay in the future. The benefits are defined for the beneficiaries, so the pension plan has a fixed obligation to fulfill. Then comes the endowments and foundations. Endowments and foundations have a large investment horizon. Their time horizon for investments may range from 50 years to 100 years. Then comes banks. Banks have very short investment horizon. They simply invest to hedge their liabilities. Then comes insurance companies. Insurance companies, their investment horizon may vary depending upon their property and casualty insurance companies, or they are life insuring companies. So these companies have different time horizons depending upon the profile of their insured people. Then comes the sovereign wealth funds. Sovereign wealth funds are the funds started by the government of a particular country for the benefit of its future generations. So the sovereign wealth funds have a very long investment horizon. So this is the table that summarizes all these funds or these investor types. Individual investors, their time horizon varies by the individual, their risk tolerance varies by the individual, income needs varies, liquidity needs varies. Defined benefit pension plans. Typically, they have a long time horizon, quite high risk tolerance. Their income needs are high for mature funds and low for growing funds. Liquidity needs varies by the maturity of the plan. If the maturity of the, like if most of the beneficiaries are nearing their retirement, then the fund may have high liquidity needs. Endowment and foundations. They have a very long term time horizon, their risk tolerance is high, and they invest, they need the income to meet spending commitments. Their liquidity needs are quite low. Then comes banks. Banks have a short term time horizon, their risk tolerance is very low. They need income to pay interest on deposits and operational expenses. They have high liquidity needs to meet repayment of deposits. Insurance companies, the time horizon is short for property and casualty insurance companies and long time horizon for life insurance companies. Their risk tolerance is low, income needs are low, and they have high liquidity needs to meet the claims. Investment companies, their time horizon, risk tolerance and income needs, they vary by the nature of the fund, and they have high liquidity needs to meet the redemptions. The sovereign wealth funds, their time horizon, risk tolerance and all these factors varies by the fund structure and the objectives of the fund. Describe aspects of the asset management industry. The asset management industry is highly competitive. The universe of the firms, it ranges from the pure play independent asset managers to diversified commercial banks or insurance companies also. Asset manager is commonly referred to as a buy side firm because it uses the services of a sell side firm. Sell side firm is a broker or dealer that sells securities and provides investment research and recommendations. Active versus passive management. Active asset managers, they attempt to outperform the markets or a predetermined performance benchmark. In contrast to active managers, passive managers attempt to replicate the returns of a market index. Traditional versus alternative asset managers. Traditional managers generally focus on long only equity, fixed income, and multi asset investment strategies. Alternative asset managers focus on hedge funds, private equity, venture capital strategies, and they generate revenue from both management and performance fees. The trends of the asset management industry are, first of all, the passive investing is growing because investors are becoming more and more knowledgeable about the whole process of active management, and they know that after transaction cost only few funds outperform the market. So the passive investing is growing day by day. Use of big data investment process is growing. In big data means the social media data or the imagery or sensor data. So all that data is used to analyze investment opportunities. Robo advisors, to meet the needs of general public, that means the least affluent people, we can say the low income group of the population, robo advisors are made so that they can help individuals They can help individuals to invest their assets at a minimal cost. Describe mutual funds and compare them with other pooled investment products. A mutual fund is a commingled investment pool in which investors in the fund each have a pro rata claim on the income and value of the fund. So each individual has a claim. The value of a mutual fund is referred to as the net asset value. It's computed daily based on the closing price of the securities in the portfolio. The fund can be set up as an open-ended fund or a closed-ended fund. In an open-ended fund, they keep on accepting new investment money and issue additional shares at a value equal to the NAV of the fund. Whereas in a closed-end fund, no investment money is accepted into the fund. New investors invest by buying existing shares, and investors in the fund liquidate by selling their shares to other investors. There are certain advantages and disadvantages to each type of fund. The open-ended fund structure makes it easy to grow in size, but it also creates a pressure on the portfolio manager to manage the cash inflows and outflows. The consequence of this structure is the need to liquidate assets that the portfolio manager might not want to sell at the time to meet redemptions. The inflows require finding new assets in which to invest. As such, open-ended funds tend not to be fully invested, but rather keep some cash for redemptions not covered by new investments. Closed-ended funds don't have these problems, but they do have a limited ability to grow. In the case of a no-load fund, there is no fee for investing in the fund or for redemption, but there is an annual fee based on a percentage of the fund's NAV. So that means there are no charges to invest or to redeem your investments, but you pay an annual fee based on the fund's NAV. The load funds are those in which, in addition to the annual fee, you also pay a certain fee to invest in the fund or to redeem your funds. Load funds are usually sold through retail brokers who receive a part of the upfront fee. The major types of mutual funds are, first of all, money market funds. These are the funds that invest in short-term money market instruments such as treasury bills, certificates of deposits, or commercial paper. Then you have bond mutual funds. It's the fund that consists of a portfolio of individual bonds and occasionally preferred shares. The NAV of the fund is the sum of the value of each bond in the portfolio divided by the number of shares. In a money market fund, the maturity is as short as overnight because they invest in short-term assets like treasury bills and CDs, but is rarely longer than 90 days. A bond mutual fund, however, holds bonds with maturities as short as 1 year and as long as 30 years or more. Then comes stock mutual funds. There are two types of stock mutual funds. The first one is actively managed fund, in which the portfolio manager seeks to outperform the index or outperform a predetermined benchmark. Then comes the passively managed fund. The passively managed funds, they follow the index funds. They are very different from the actively managed funds. Passively managed funds have lower fee as compared to the active funds. Their goal is to match or track the performance of a benchmark. A hybrid or balanced funds. Hybrid or balanced funds are funds that invest in both bonds and stocks. They have gained popularity with the growth of life cycle funds. They manage the asset mix based on a desired retirement date. Then comes the separately managed account. SMAs are managed exclusively for the benefit of a single individual or a single institution. The assets of SMA are owned directly by the individual or institution. The disadvantage of SMA is the required minimum investment is much higher than that with the mutual fund, and also SMA has higher costs as compared to the mutual funds. Then comes ETFs, exchange traded funds. ETFs are investment funds that trade on exchanges and are generally structured as open-ended funds. The key difference between ETF and mutual funds, it relates to the handling of transaction costs, treatment of dividends and the minimum investment amount. Dividends on ETFs are paid to the shareholders, whereas mutual funds usually reinvest the dividends. The minimum required investment in ETFs is usually smaller than that of mutual funds. Hedge funds. Hedge funds are private investment vehicles that typically use leverage, derivatives, and long and short investment strategies. Hedge fund investment strategies are diverse and can range from specific niche strategies such as long short to global multi strategy approaches. Hedge funds have a Hedge funds are used by investors for portfolio diversification purposes. Hedge funds characteristics are short selling, absolute return seeking, they have high leverage, they have low correlation with typical equity strategies, they have a high fee structure. Now let's talk about private equity and venture capital funds. Private equity funds and venture capital funds are alternative funds that seek to buy, optimize, and ultimately sell portfolio companies to generate profits. Unlike the traditional asset managers, private equity and venture firms take a hands-on approach to their portfolio companies through a combination of installment of executive management and board members and significant contributions to the development of business strategy. The exit occurs when a private equity or venture capital fund divests its portfolio company through a merger with another company, the acquisition by another company, or through IPO. So this is for this module. In the next video, we'll cover the basics of portfolio planning and construction. Thank you very much.